All right, how can investors unlock liquidity from single stock holdings? Well, Travis Schindler joining us now from Hewison Private Wealth. Travis, welcome back to Ausbits. Good to have you on the show. Well, we talk about unlocking that opportunity, particularly with one stock. What's your focus?
Look, it's a couple scenarios that we've been seeing recently, particularly with a number of high-profile listings. Senior executives from those companies might end up holding single stock positions with large levels of equity. So just looking at ways that your viewers can potentially look at unlocking that equity for other purposes.
All right, so this is for looking at for individual investors, but also for private banks as well?
Yeah, so look, it's a funding solution that typically is not available at the retail level. So wholesale or sophisticated investors, executives of companies, or potentially those that have inherited, historically large positions in single company shares, without wanting to liquidate or crystallize those positions, how to unlock equity for other purposes of wealth creation or diversification. So it's traditionally available through investment banks or private banks, but really what it really is at its core is a bespoke funding solution to unlock equity and diversify balance sheet equity from a single stock position.
Look at the structure then that is possible. First one you mentioned is the open facility. Just talk us through it.
Yeah, so what one option that we've seen in the marketplace and have been exploring it with a number of clients is the use of a collar strategy. So selling a call option, buying a put option, and effectively offsetting the cost of those options with the income earned. So it can be structured in a way where there is zero cost. What that option facility means is that the downside is protected. It also means the upside is capped. But then it gives a clear path towards using that equity to create a loan facility that can be used to reinvest elsewhere.
All right. Also, use of a loan facility. What's that entail?
Yeah, so really, it's unlocking the equity to use that money for investment elsewhere. It's typically for a set period of time. So investors need to be really looking at what happens at the end of that term. How can that facility be rolled over? And what are the downside risks if the share price falls? How will that facility be closed out? So it's really important for investors in this unique situation to make sure they get the right credit advice and make sure they understand what can happen in the downside, which is effectively the share price moving against you, and having the capital to close out the position or roll the facility over. But with markets where they are today, over the last couple of years, there's been a number of companies that have listed. There's also a lot of corporates that have executives that have these large stock options that really might want to be thinking about how can we diversify the equity that's within these positions to reinvest elsewhere.
Travis, can you give us an example, perhaps using the largest stock in CBA?
Yeah, sure. So if I look at use CBA as an example, by purchasing a put option, which comes at a cost, the cost of that can be offset by selling a call option. The income from that can be used to offset the cost of the call option. Potentially with the right structuring, it can be done in a way where there's a neutral cost. And then your downside's protected, your upside's capped, which is something that investors need to consider. And then it's just a straight cost of the interest attached to that loan. So it's really then the typical considerations that come with a leveraged investment strategy. So borrowing to invest is my likely return, cover my cost of capital, and is the risk reward there for me to consider that? So I guess that's the type of considerations that need to be made. At its core, it is a borrowing for investment strategy, a gearing strategy. But it's really for that unique situation where there's a lot of equity in a single stock position, and the investor might be prevented from selling it tax effectively because there's a significant capital gains outcome. So it's just about creating the mind frame that there are options out there for those unique situations.
Can you just talk us through those the risks that need to be considered?
Absolutely. So, as I said before, if the market moves against you, closing out your position, need to understand what are the terms and conditions of that lending facility. So it's really important to seek the right credit advice, the right financial advice along the way. If the stock price does move and there's a trigger event involved in that facility, what is the mechanism for your loan being closed out? Do you have flexibility to extend that loan or roll it over? So it's really important to look at the risks involved. And of course, on the other hand, the benefits can be things like the interest cost can be tax deductible. Obviously, it's critical to seek the right advice from a tax perspective on that, and being able to diversify into other assets away from that single exposure to potentially other asset classes or other stocks if it's a traditional equity.
Travis, just briefly, what are perhaps some other funding options that would be available?
Yeah, so there's traditional margin loans which are a bit rigid and can be inflexible, but there's also other facilities out there that might not use those options that I explained earlier. So potentially there's uncapped upside, but then of course on the downside, if the share that you're using a security to borrow for investment, if the share price goes against you, the consideration there is that you might have a very short amount of time to actually come up with extra stock posted as security or the cash to bring the OVR back into a range. So there's one option which we spoke about earlier, which had more protection with the use of the collar strategy options. And then there's other types of strategies like a stop loss loan, as I said, but there could be more volatile outcomes involved with that.